Hey, what's up, Outliers? Happy Wednesday. Goal for the stream today, pretty quick and straightforward. We're just going to walk through how the week's going so far, see if anything sticks out to us. I do want to spend a little time poking through earnings. I like to do that. We didn't get a chance to do that on the stream yesterday. That's a lot because we were kind of focused on like trying to screen for earnings plays and stuff for the week. So ran out of time. So I want to spend some time on this stream doing that. And let's just start with getting a level set on what's going on, because the market's actually at a really interesting point here, in my opinion. When we see what's going on under the surface. Now, we know that pretty much across the board, we started seeing a little bit of a roll-off. So S&P down a little bit, Q's down a little bit, and small caps down a little bit. VIX hovering in the mid-15s. VIX still very muted. Now, a couple of things that I find really interesting. The first one is if you look at futures on the open right now, we actually see E-minis up, Russell down, Q's up more. Now, this has everything to do with earnings, which, again, we're going to talk about. But these relationships are very interesting to me, because small caps have almost become a proxy on the rate environment. Like across the board, that generally holds. And the FOMC release today was absolutely fascinating. And I'll explain why. Before, I do want to highlight, as per usual, some sector trends. We spent time on a recent stream walking through, I think it was on Monday. It wasn't on a stream. It was actually on one of the Zoom workshops for the Pro Plus folks. And on that workshop, we actually spent time looking at a couple momentum factor strategies. And to simplify, rather than holding top deciles of a large basket of stocks, we narrowed it down to just starting with some sort of sector ETF, which there's a really viable approach there. And we're seeing a key change across the sectors, though. And I want to talk about that. If we take a look at XLB, that is rolling off pretty heavily from near-term highs of 92.5 to now being in the high 80s. Now, this is all relative. As a raw dollar amount, that's not much to write home about. But relative to XLB, that is a larger move, right? These are all pretty big sectors within the S&P. Comm services rolling down. Energy, as expected. I literally talked about this, again, on a stream not that long ago. Just the rally looked pretty good, but I absolutely anticipated a subsequent retracement. And it's just because that, again, that's not like me knowing what's going to happen. I have no idea what's going to happen, but this is what I expected to happen. And it's literally just playing the longer term trend of what this thing is doing, right? Energy has been down and struggling for a while. Financials continues to be a pocket of strength. So even though financials is also following suit and trickling down, it's still hovering near all-time highs, which is an important metric also for industrials. And then we can see XLK Tech is essentially right in line with all-time highs. So what's going on here? A couple things really catch my eye from a trader's perspective. The first one, the relationship between XLC and XLK. This is now becoming broken again. This is a go-to pairs trade for me. And I monitor very closely the relationship between these two so that I can trade not necessarily the price direction outright, but trade the actual relationship, which does tend to normalize. So that's getting to an interesting divergence. So that's one thing to take away. The next thing to take away is I still view energy in a very delicate spot here. It's not looking super strong yet to pop above the 90 handle. Can happen whenever, we never know. But the way that it behaves at this point is most interesting to me. Do we see it continue to consolidate up here and maintain the term lows? If so, that's generally indicative of a trend reversal, meaning from this downtrend, which would be bullish. If we see it start cracking below these term lows, that's bad. That's generally trend continuation of this longer term trend to the downside. So again, as per usual, I really don't try to predict what's going to happen necessarily. I try to look at how things are behaving and come up with a probabilistic assessment of which ways they might go, and then evaluate whether or not there's a good trade that ties to those probabilities. Financials still looks good to me. Staples coming down, I actually think that's generally good because there's a couple consumer metrics that came out earlier this week that were actually a little bit soft. I'll show you those. Here. So if we take a look through just the general state of the consumer, so far, manufacturing index came in pretty good. I actually was generally stoked on that. Consumer confidence. So the metric came in at 97.2. The consensus was at 95.8, forecast 95. So the metric itself as a top line number, not bad, right? That looks completely okay. If you click into this metric, there's a lot of signs of weakness. So that's the downside when we look at big metrics like this top line can give you a perception, and then I'll grab it for us to take a look at together really quick so that you could see what I'm referring to here. So you can take a look at it at your own leisure as well. But this is not good, right? So if we track this trend, the trend is not good. So the fact that we have this small little blip is okay, right? It's not falling, but this still, just like a stock chart, this still is a downtrend. And when we look and we deconstruct what's happening in there, this is still pressuring a lot of people. So tariffs remain top of mind, mostly associated with concerns that they would lead to higher prices. In addition, references to high prices and inflation rose in July, even though consumers' average 12-month inflation expectations dropped ever so slightly. So what I'm seeing here is a little bit of a turn on the front of the consumer. Now, again, you guys know I like to use Fred. That's a little too lagging. There's nothing in there that I can pull yet that's given me direct confirmation on any of this. But this is a great point to remind ourselves of the relationship between the economy and the stock market. The stock market is forecasting, it's discounting future cash flows into today, right? So it's looking out into the future, 6-9 months, kind of depending on the broader economic forces. When we're talking about a lot of these economic pictures, these reports tend to come from lagging periods. So we get a metric today that shows us lagging data based on what happened previously. So a big part of what is typically smart to pay attention to is not necessarily the actual metrics themselves, but the trend of these metrics. And right now, the trend of the metrics essentially is showing decent consolidation here, but still that broader downtrend. And although we are seeing new tariff deals coming out, if I'm not mistaken, there was another tariff deal announced today, I'm pretty sure with South Korea. And what Trump is doing is pretty smart in the context of using US investments as another lever to pull. And I think people started to crack the code on this. So let me grab that really fast so that we can see, make sure I'm not fucking spewing bullshit too. South Korea trade deal. Yeah. Here. So let's grab Bloomberg. Oh, you bastards. We will just go somewhere else, Bloomberg. I don't know why they fucking paywall an article that is literally everywhere. It just looks silly gilly. So tariffs there look like 15%, lowering from the 25% that went out in the tariff letter. And then this has been a common theme. So South Korea will essentially have 350 billion for investments controlled by the US. This has been an ongoing, very interesting lever that we're seeing pulled, but it is giving people a really good method to manage around these tariffs. I think it really is pretty smart. So the problem, though, is let's get a map. Current map of Trump trade deals. There's a couple websites that are actually plotting this. Let's try this one. And then this is another one. All right, let's see. I want to look at the actual deals. It'd be nice if the fucking column stayed. Nigeria, threat. I love that. Threatened. So anyways, as we start flipping through these, one of the things I want you to pay attention to is the fact that there's not like a shit ton of deals that you see. And the reason for that is Trump is doing what he can to promote the wins, promote the ones that do have deals, and that's good. We should do that. But it's important to always maintain visibility on the broader picture. And the broader picture here is there's still a lot of fucking things that don't have deals. And we are still coming up hot on a deadline, which we'll talk about in a second. I just realized that we're spending a little more time talking about tariffs than I thought. So I'm gonna add that to the title. So let's see. These are just the rates. I want to see the ones with deals. Here we go. So this starts to show current deals. Can I make this fucking map bigger? At least I can see this one. So here's what we're sitting at. Ireland, Britain, Belgium, Netherlands, Germany, blah, 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 blah. The key here is that there's a lot of things on this map that are real big blocks in terms of imports that are fucking gray, right? This one, we kind of know who these two are. So what this means is the broader uncertainty around these tariffs is still there, not really gone. We have a couple key deals, I would argue. South Korea, Japan, Vietnam. Those are pretty big deals. Same thing with Germany, for sure. And then I also think Ireland is a little bigger than people give credence to, specifically from like a medical pharmaceutical side of stuff. So like fair play on all of these. But again, if we take a look at these three blocks compared to everything here, they consume everything easily. So even though it's good to see these deals rolling out, really the bigger levers are still TBD. So then that question becomes, is there a tradable idea here? Because I believe there is. I believe all this stuff is typically tradable. And one of the ways that we can think about that is, how is the market currently pricing this event? Because again, we know that there's a lot of news coming out about tariffs and Liberation Day and all that fun stuff. So let's take a look at S&P and let's see what S&P tells us. If we take a look at vol for 1 August, what do you notice about the vol for 1 August now compared to 4 August, 5 August, 6 August? What do you guys see? Pretty clear trend. And this is also a very different trend than what we had seen previously. I actually think we might have a plot somewhere. I think this is it. No, this one's it. So this is an example of different term vols that I've lazily been tracking around this news piece. And let's take a look at 30 July now, just add it to our list of stuff. And all I'm doing is plotting term vol for essentially business days before and after. What did I miss? The workday function is relatively new to me. What do you need me to do, workday function, for you to be happy? Start date, number. No, man, I want you to do math. Do math. I fucking hate this thing. Come on, ChatGPT, hook a brother up. Tell me how to complete this ridiculously simple formula. In S135, I want to calculate the workday minus 1 from S136. Look a brother up, ChatGPT. Oh, it's got to be in the parentheses? That's so fucking lame. Pfft. Whatever. And now these we need +1. I don't think that's right. Oh, I see. There we go. Cool. So the reason why I'm doing this is so that we literally can create a cool little plot. So let's grab our term vols now. Move this off to the side. I'm going to skip 30 just because it's today and the vol obviously will already be completely contracted. So then we have 14.96. And then we have for 1 aug 16.54. For aug 12.14. And then 12.26. And all we do is add this to our plot. And the cool part about doing this is you literally can get a sense of how things have behaved over different timeframes. So now on 30 July, we can measure. What color do you want 30 July? About a fucking crazy ass purple. That's kind of fun. So we can now see the relative vol around this event. One of the things that certainly sticks out to me is the fact that the vol around the event has absolutely gotten more pronounced, for sure, without a doubt, right? So we can see back on 21 July, we can see how this relationship between the day of, the day prior, and the day post. And then we can see how that's essentially morphed over time. It actually got less volatile. And then it subsequently has gotten way more volatile. So another way to visualize this is to plot the changes between these. And that sometimes can help create a different version of this visual. Now, as we're doing this, for those that are in the chat, what do you think of what I'm showing you? Does this give you any ideas? Because ideally it should be. When we're reviewing this kind of stuff, I really aim for you guys to have, again, I don't want to necessarily call it all aha moments, but I do think that learning how to take these and turn them into tradable ideas is always useful. And you should be able to do that as we're kind of talking about what we're looking at here. Ree says, I got a little lost. Okay, cool. That's totally cool. Explain to me the pieces where it feels like you got lost. what elements of this is getting you? I'm going to remove this and I'm going to add a couple different versions of this just so that it is easier to see. The reason why you don't see the other plot is just because of how I have it gated right now. You'll see it in a second. So now all I need to do is for all the changes, I'm going to add them to the right axis. There. And then to normalize these, I'm going to get rid of these two just so that the plot isn't as chaotic. I say that as the plot probably looks super chaotic to you guys, I imagine, with all the data points on it. Let's do one more version of this super fast. I'm gonna, actually, can I just copy this whole thing? Great. I'm just gonna give you two plots. So that's just plotting the vol itself. This one will plot the changes. Good. And then all of these should go away. Okay. All right. We need this to be able to go direction. Perfect. All right. So here's what we can see. What's happening right now is the relationship around the one AUG. The dates here got all fucked up somehow. I don't know what happened. But the dates here are super important. We can see that when we plot the vols across these different periods, that there's a very, very clear relationship underway. And the relationship tells us that the market right now is absolutely pricing in and expecting an increasingly larger expectation of something to happen during the 1st of August. And then to make that relationship look a little more clear, we can see the relationship of these, which is the changes pre and post. So what really should stick out to you here is when you see changes look this significant, it actually tells us, especially post the date, that the market is increasing its expectation of volatility through this over time. So the market started not super vol heavy in terms of their expectation, but then you can see that it absolutely significantly scales its expectation of vol. So with all of that, Kirk says, I feel like 12 AUG is more important for vol based on tariff news because the China deadline, but it's much lower than 1 AUG since the 1 AUG expanded in vol as it got closer. Yeah. So that's a important note to keep in mind, is that what that says, Kirk, is right now the market is way less concerned about this. And it's for a bunch of different reasons. There's probably also a reality when we look at China, understanding the natural expectation that that one specifically will probably come through unscathed. And that's just because it's directly mutually beneficial to do so. So vol can be elevated in different terms. So the fact that the vol around this 12 August term is so low, it tells us even though it might expand as we get closer, what we saw before is this vol was still elevated. So what I mean by that is even though the vol for the 1 Aug date is building, we can see that here, right? This is 1 Aug. We can see this date building. Yet, with that, this vol was still elevated compared to the day prior and the day post. Now, if we take a look at that relationship here for 12 Aug, we can see 12 Aug is at 12.95% vol. 13 Aug is higher at 13.11% vol. And then 14 Aug is at 13.49% vol, and then so on down the surface. So that is a clear takeaway on what the market is pricing in terms of risk and risk expectations. ZXborg says, is this similar to looking across SMTH, something like an earnings event? Yeah. So this is very similar to looking at something that's the market is telling us in terms of how vol is being priced, what it expects. And when we see this kind of movement, it's very clear that the market expects more volatility around this 1 Aug event compared to other relevant timeframes in the front. So then there's a ton of tradable ideas based on this. We're actually going to go through some of them in the workshop tomorrow because it'll be really timely relevant to it. But you can play either an expansion in vol, a contraction of vol, post-catalyst vol, essentially the same thing that we have for a standard earnings playbook. Now, the cool part about it is even though this event is relatively unique, we have a lot of references that we can use to shape our idea. Now, that said, those references still won't directly address what we're going to see because these are very unique. There's not a lot of look back points that you can base off of, but there's a lot of proxies, and those proxies can be really, really useful. Let's talk a little bit about the Fed. I think the Fed was very interesting today. I want to see if they talk about it in here. If not, I can grab a direct thing. Here we go. So the Fed voted 9-2 to keep the Fed rate unch. Bowman and Waller dissented in favor of a cut. So it's the first time since 93 that 2 members of the board dissented. This is why you see that market movement today. And this is also why, so far, I believe there's a lot of rhetoric around, the political misalignment between Powell and Trump. But this is actually one of the first times that I think that there's probably palpable evidence of that actually playing out in this instance. Because generally speaking, the FOMC is pretty lockstep. Again, you can see, right, from 93, we generally see FOMC in lockstep. Yet this kind of dissent actually starts to light the question mark of how much of this is political at this point? The fact that we're still not cutting rates up until here. Because clearly there's enough of the Fed that thinks we might at this point be higher favor of a cut. Because part of this 9 also identifies more with the 2. They just want to be with the 9. Rickson says, why would they favor a cut when stocks are making new all-time highs? They don't really care about stocks. It's not about cut timing relative to stocks. It's actually a really common, I think, misconception. The market itself is a useful data point, but really what the Fed is going to be looking at in the decision really has everything to do with inflation and the broader impact on the economy. So one of the reasons why a lot of people, especially more market-friendly people, have been advocating for a cut is because of the leads and lags in these relationships. Again, like we were talking about that other indicator earlier on consumer confidence and how that's backwards looking. So is this. So here's what's happening. If we think of a time series that pretend that's a flat line, we have a time series. And let's say that this first line is rate environment. So the rate environment went essentially from near zero, it went up, it's since plateaued, and then it's come down ever so slightly and then plateaued still. So what's happening right now is the Fed, their job is to monitor this rate against other relationships. So one of those relationships will be inflation, which would have started really high, maybe grown a little bit, and then is, subsequently come down slightly, something like this. None of this obviously is to scale. Just the general trends matter here. And then the next thing that matters is the strength of the economy. How strong is employment? Are we seeing big layoffs? Are we seeing a lot of cracks in production, manufacturing, all that kind of stuff? So essentially what's happened is the economy started strong. It, got a little weaker, but it's been really, really steady across the board. Here's the problem. If these rates remain too high for too long, what can end up happening is the economy can take a pretty nasty turn pretty quickly. It doesn't take that long. So it becomes a game of chicken, essentially. And it's a delicate dance of how well can we keep the balance between keeping rates to tamper inflation without crashing the economy. And objectively speaking, they've done a fucking awesome job so far. Against all of the critics, there's so many people that have so many fucking things to say about what the Fed has done and what they should have done and how they should have done it better and they should have done this. Everybody always has a fucking opinion. But the fact of the matter is we're not in a deep recession right now. So that in and of itself, pretty fucking good, given the amount of quantitative easing that we went through, which is absolutely crazy. So kudos. Now the question does become, when is it the right time to start tracing rates back down? And that timing is deeply important. You can start to see a crack in what that timing is expected to be. The fact that there was two that were willing to go on and show that they dissented is important. Because again, in general, even though that they might vote together, I guarantee you that there's dissent that doesn't materialize into voting dissent. It might be, hey, I think we should do this, go back and forth. And then at the end of the day, so that they appear as a unified front, they will simply vote together. Because the two that voted here, they know that they're not going to overturn the 9, and they probably know the way that the 9 are going to vote. So what this tells us is this is like on record dissent. This is Bowman and Waller saying, I think these other people are doing something that doesn't make sense at this point, and I don't want my name wrapped up with them. That's effectively what this is. Now, there can be a really deep game theory behind why that is, right? Maybe are they trying to position themselves post Powell leaving to maybe pick up the mantle and all that kind of shit. So there's a deep game of politics going on behind this. So you can't immediately take it as this is coming based on this, because there's a lot of other stuff going on. But the fact that this is something that we're seeing in and of itself is an important metric, bar none. By itself, something we care about. So, Dot says there's a question about housing rates, and the response to it was that these are overnight rates for banks to do business. then how is this not translating to regular savings accounts? So some banks will give you better rates. A lot of banks essentially are, I don't want to say penalizing, that's dramatic, but if it's something like this is why there's a difference between like a CD account, a checking account, and a savings account in terms of the yields that they provide, because there's a liquidity expectation between these different accounts. So if we take a look at, we'll literally grab an example out of curiosity because I don't know. But let's just scope this out really fast. Checking, savings, and then CD, certificate of deposit. So if we were to rank liquidity and yield, this is highest liquidity, lowest yield. This is mid liquidity in the context of these accounts. These are all super liquid, by the way. Mid liquidity, typically mid yield. This is low liquidity, high yield. So the reason why you're not necessarily seeing it coming through direct one-to-one is because there's a liquidity factor that's being applied. Now, what ends up happening is the banks are also trying to make money. So it's not going to be some sort of one-to-one relationship because the bank is still going to loan this money out. So the bank needs to be able to loan it out at a rate while giving you a rate, and still the bank make money. So that's the short version of why this is. Now, I am actually curious really quickly is, let's just do like Wells Fargo. Wells Fargo checking account yield. Just give me the fucking... It needs a zip code. Jesus Christ. Here you go. Damn. They like fucking bury this shit. So there's your checking rate. Let's do savings. Well, I guess it's giving me a CD, so we'll just pick CD. So these are savings accounts. I'll read them to you in a sec. And then these are CDs. So here's what's happening. They're saying on your checking, we're essentially not going to pay you. We're providing you liquidity. You're effectively not going to get anything. Then when it comes to savings, they're saying, if you don't have a lot of money in here, we're not going to pay you a whole bunch of money. If you have more money in here, we will give you more money. Why is this? Because the likelihood of you running through $100,000 is less or is higher than the probability of you running through $500,000. The point here is there's an inferred liquidity and an expectation of withdrawal amounts. These brackets aren't random. They're built very strategically based on this stuff. So they're saying if you put more money in here, because they're going to assume it's going to be more stable of a value, we'll pay you more money. Then essentially, if you make an agreement in a CD account that you're going to leave the money in here, we'll pay you even more still. Now, the interesting thing here is, for a lot of people don't know, with CD accounts, with a CD account, you can always withdraw your money penalty free. Your principal is always safe. What's not safe is the interest earned. So if you withdraw from a CD account early for some reason, you don't have some sort of big, massive penalty on your principal. Again, you have to check with your individual institution. This is broadly speaking, but you generally speaking will forfeit some of the yield. So they'll have different terms, right? So the early withdrawal penalties, let's see what they say, just out of curiosity. They'll typically explain exactly how those penalties work. Which is super easy. So this says regulation penalty, withdrawals made 7 days of account opening. Penalty is 7 days simple interest. Then other than regulation D, if it's less than 90 days or less than 3 months, the penalty is 1 month's interest. If the term of the CD is 90 to 365, penalty is 3 months interest, and so on and so forth. So that's just a thing a lot of people don't know. That's generally good knowledge to share with Aunt Greta at the next family barbecue. Now, one other thing, just out of curiosity, is I can calculate what the box spread yield is right now. And for those that are in the Patreon, you guys have access to this exact calculator, because it's just a useful tool for stuff like this. So what I can do is I can say, what's the 3-month yield-ish on box spreads? And you can always do whatever, width you want. It doesn't really matter. The width for calculating this is all pretty similar. So you can figure out exactly like what the inferred yield is. So if we do something like the 6350 box spread to the 6400, I'm literally just picking something, we can figure out what the inferred yield is. So today is 30 July, or JUP if you spell it wrong. The expiration we're looking at is 17 Oct. The spread that we're looking at is 6350 to 6400. And then the premium that we're going to pay on these at the mid is 49.5. So this tells us right now that the inferred yield on this is 4.574. This is including, let me see if I have this. Yes. I'm making sure if it includes drag or not. So the main point here is you can literally identify the risk-free rate using box spreads, and more often than not, you'll get more here than all those other places. This is why I use them over pretty much everything else. Same thing compared to using like iBox or, like the different kind of holdings that you can use. Gilgo says, I bought options on the VIX, 5 calls, 15 strike. Cost base is 311. First time trading the VIX. I might buy 5 more if I can get them lower. Just be careful with that. The probability of you lighting money on fire with that trade is super high. That's just the way you have to go into it. So yeah, just as long as you're going into it with that expectation and just kind of testing stuff out, have some fun. That's cool. But yeah, the overwhelming probability with those kinds of trades is you're just lighting the money on fire. Matt says buying a home at 7% was rough. Almost perfect credit estimate. Is real estate maybe part of why rates eventually get cut? I don't know anyone who's buying a home that didn't have to. Yeah, well, the other thing, again, to remind yourselves of, like the impact of SOFR rates on mortgages is not really the same thing. There's definitely an impact, but the mortgage environment also is going to be specific to itself. So even if you get a small cut up front, that doesn't mean you're going to see the same change on mortgage rates, because you're talking the longer tail of the yield curve. So again, just another thing to be aware of. The rate cuts up front aren't necessarily the same thing that people expect on mortgages. The other problem, anyways, is I think Americans got way too used to just insanely cheap mortgages. A 7% mortgage really is not, that's like historically speaking, that's about average. Like that's what most people expect to pay longer term. We just went through a period of time where all of us got spoiled with otherworldly cheap mortgages, literally otherworldly cheap mortgages. We've been spoiled. So 7% really isn't that much for a mortgage. It's about right. So there's just an entire industry built around that, because the other thing that you didn't see a lot of that there is an industry built on is paying points down, which nobody, like when I bought my house in 2020, there's a reason why I bought my house in 2020. Literally timing that, right, for leverage. And nobody's like paying points down when you're getting rates that are sub 3%. There's just no reason to. But there's an industry around that otherwise when rates are higher and like the 7s, 8s, 9s, where people will literally pay points down so that they can decrease that. But yeah, it's definitely a completely different housing environment, no doubt, that I think got a lot of people. Kirk says, everyone for the last 3 years bought with the expectation of refinancing. Hasn't happened. Even if the Fed cuts, the 10-year could be unch and mortgage rates could stay the same. Yeah, I think that that's a really fair way to think of it, because I don't know about the expectation of refinancing soon. There's no real way for us to make that statement logically. But I do think a lot of people that might get mortgages could do it with the expectation of trying to refinance. But again, I think like if I were to get a mortgage now, I wouldn't have any grandeur expectations of like a big refinance. I still would probabilistically expect it to happen, maybe to hit the 5.5s. But the issue is you really can't bank on it, right? There's just so many factors to go off of. Kirk says real estate agents sold them on the hopes of refinancing. Yeah, I mean, again, I don't doubt that happens, but I'm reluctant to make statements like that I can't objectively qualify or quantify. So I think it's okay to have that hunch, but yeah, like I don't have any data that would support that. I'm sure that there's probably some sort of real estate survey that would give us something on that, right? Like the number of people that bought with the expectation of refinancing. I'm sure that there's got to be some data out there on that. Let's pivot now. We talked about tariffs. We talked about FOMC. Let's talk a little bit about earnings, because like I said, I didn't get a chance to do that previously, and I would have liked to. So earnings season so far is obviously just cruising right along. And this week has been full, absolute full of earnings plays. There's a ton of stuff that is on the docket. But I do want to go through and just selectively poke through some of these earnings releases, because I always think that it's really, really good context. So let's take a look at VZ earnings. This is generally good from the context of the industry itself. So let me grab the presentation. And we'll flip through this really fast. I'm just doing this to see what kind of information I'm actually curious what the summary will come up with. That's kind of cool. Okay, so this is effectively fucking useless. Thanks. All right. Let's see. Okay, so wireless service is still expanding. EBITDA is growing. Cash flow is growing. Broadband is contracting. Wireless revenue is good. Total revenues look good. So just still growing the business. Guiding up EBITDA growth, guiding up EPS growth, and guiding up cash flow. So that's good. Good forward guidance. Okay. So let's take a look at another. What do I want to look at? Let's take a look at Coke. Let's take a look at their... Is it in this? Man, give me a presentation, you bastard. You guys serious? I hate you guys. So, wow, operating income up significantly, net rev good. Case volume down. That's actually interesting. %6 growth in price mix, 1% in concentrate sales. Okay. Share a Coke campaign. Apparently that worked well. Campaign contributed single serve transaction growth. Coke Zero Sugar achieved double-digit volume growth. So, Cliff Notes, people still like soda. It's almost like if you give them fucking concentrated sugar, crack cocaine in a can, they'll drink it. That's my takeaway. Give me 1 sec. I gotta pop the door for Thor. It looks like he scratched and then vacated. He did a fucking ding dong ditch on the door. Oh, let's see. Europe growing, Latin America down, North America down. Unit case volume decline as growth sparkling flavors more than offset in trademark Coke. Price mix 3%. So overall, this also looks generally good. Dot4G says they're going to use raw sugar instead of processed. Yeah, I saw that. I think Trump made a thing about that as he was trying to tell everybody to not worry about the Epstein files anymore. Coke is using real sugar. Fucking sick. Let's take a look at Enphase. Okay. And let's see if anything sticks out here. I'll zoom this in a little bit. There we go. Fucking great photos, everybody. Nobody gives a fuck. See, this is how you could tell it's a company that is still like growing and try to grow revenues and stuff. And you can always tell the developed companies, right? Like developed companies, they just fucking give you numbers. They're like, yo, here's the money. These people are like, hey, man, fucking look at me and see that I'm a human, which is nice. Cool that there's humans, but show me the fucking numbers. Their core differentiation, predictive control, architecture, management technology. Yeah. Dude, show me the numbers, bro. What the fuck? What is this, like a business pitch? What am I looking at? Oh, this is, oh, my bad. That's my fault. That's on me. This ain't on them. This is an investor relation deck. My bad. I'm gonna say, this is fucking crazy. There's the numbers. Here we go. Quarterly revenue. Let's see. So gross margins are still good, but slowly contracting. Operating expenses coming down. Operating income up. Good. Net income up. Good. EPS growing quarter over quarter and not year over year. So that I love a little less. Revenue up quarter over quarter and year over year. So record battery shipping. That's good to know. There's a new energy system going out. I'm curious how the uptake of that is going to be. I wonder if they have sales by type. It doesn't look like it. This is what I want to see. Okay. So, I mean, this looks like pretty solid growth. I fucking knew this was coming up. I was curious what's been going on with this. I've been following this trend for a little while. And it's been really, really interesting seeing the free cash flow trend. But they're pulling in plenty of money. So I'm sure it's a strategic decision of some sort. Let's take a look. I think we looked at Tesla already. Let's take a look at maybe one or two more. Let's do UPS. And then I will pivot and just talk about earnings trades performance a little bit. All right, let's see what they got. Revenues down slightly year over year on the US domestic. International revs up, supply chain down. So UPS is under a little more strain, just at the very top line is what I'm picking up so far. The company is not providing revenue or operating profit guidance, but confirms the following for the full year. So this is obviously talking about the tariffs and all that shit. Transformation strategy spans several years. So fit to serve. It's just a bunch of other fucking initiatives that they're running. All right, let's see. So yeah, I mean, they're kind of not doing super great. Like that's one of the big things that I see going through here is like they're really not doing super great. The US domestic is contracting quite a lot. Because here's the problem. Like the international stuff is good that there's some level of growth. The problem is it's still such a small part of the business, right? It's mostly US domestic. And then they're falling on supply chain and stuff like that too. Let's take a look at their behavior. Zed says, found your channel. Glad to see you've been enjoying GME Library and Super Stonk Guide magazines. Oh, yeah, boy. We've been on that for a while. It's like fucking 50 episodes now. Been digging in pretty deep. Yeah, I mean, this makes sense for a company that's not driving a lot of profitability. Realistically, I don't think I traded earnings in here. Let me take a quick look. I'll tell you guys. Was it yesterday? Yeah, we skipped on that for sure. Their earnings have been all over the place. So no trade on earnings there. Earnings this season so far is pretty solid. I've had a couple pretty significant moves for context. I had one 4 standard deviation move, 2.84 standard deviation move, 2.72 standard deviation, 169 and 169. So overall, the total number of trades right now is at 46 for just this earnings cycle. And that's like a decent number of pretty big moves. Like anything over 2 standard deviations is notable, right? So it's a little under 10%. So those kinds of things can really skew P&L. You have to have a pretty robust system in place, especially when trading stuff that has a higher probability of those kinds of moves, which I still think is super, super important when you're trading earnings. The difficult part in trading earnings is making sure that you're sized correctly. Very easy to be oversized, especially when you're talking about stuff that can have 3 to 5 times the standard deviation or the expected move. So it's super easy to get ran over. A couple trades. I haven't done a lot of this with you guys lately. The other thing I did want to tell you guys about is the covered strangle portfolio is still alive and doing well. One change I am going to make in it, though, is I have a couple investments coming up that I'm using my primary portfolio for. So what I'm going to do is scale down the sample covered strangle allocation of the portfolio to kind of mirror what I'm scaling down in the main portfolio as a percentage. The reason why I want to do this is I think it gives a really, really good example of like the real flow and management of a portfolio, which is the entire intent behind it. So once I finalize like the different disbursements from the trading account that are going to go into different things, then I'll essentially apply the same percentage to the model portfolio, because I think right now it's at like 6.25, and I don't know what it's going to come down to, but I imagine it'll be a pretty meaningful drop because I have a couple fairly large investments coming up. So I think that'll be a fun exercise. Now, that part aside, I do want to talk about a couple recent trades, both good and bad. So something that I'm noticing is working well is still trading vol in the indices for sure. And trend following is there's a couple really, really solid names from trend following so far. CCJ has been a pretty good one, although today technically it hit a spot where I would be scaling out. I have not. I've chosen not to, but it is technically at a spot where I would. I'm not, simply because I'm still playing a slightly longer game in there, and my portfolio is underexposed right now because I'm preparing for travel and stuff. So for a couple mixed reasons like that, there's a change there. The other stuff that is doing well on a trend following lens, QBTS has been good, definitely giving up some over the last few days coming into earnings. Palantir's been really good. ASTS has also been really solid. And I've recently taken down, I just took down SoFi not that long ago. And I still, like I said, I still actually like SoFi. But again, I'm just kind of preparing the portfolio for traveling, where a big thing I do is I just purposefully avoid stuff that requires really any sort of management on my end. I still trade when I travel. I just prefer it to be more optional. And another that's been kind of fun to play is QS. I got into it on two phases into it. Yeah, I got into this in 2 phases. Trying to find the first entry. The first entry was here on the 26th. And then the second was here on the 8th. And then I started scaling out of that on the 24th. So here is where I began scaling out. So this one, I still like it, but it needs to stop falling. Really. I'm just setting a bunch of alerts so I can keep an eyeball on it so I don't miss it. Okay, Thor's back. All right. I've got the dude. He is ready to, I mean, he's ready just for everybody to just make a bunch of money. I think that's what he was just telling me. Oh boy. Zed says magazines were a lot of work, but so much fun. Yeah, I think so too for the GameStop stuff. Completely agree. Ambient says, in your TA video, you mentioned using Excel to test directional predictions. How many days of data should I track to evaluate if my analysis is effective? That's a great question. I think it depends on what kind of analysis you're doing, right? And a big part of that will depend on the frequency that your analysis is presenting itself. So the way to think about that is twofold. Easiest is to track the variance between the different situations. So I'll give you an example of this in like a visual format. I think it'll probably be easier for you to understand what I'm saying. One of the things that you want to see in a developing strategy is something like this. I actually used this example not that long ago. Something like this. So this is a P&L plot for a live strategy that I'm running. And you can clearly see where the refinements were laid on. So all I'm doing is plotting the P&L for the individual trades. And we can see that for the specific strategy, it was all over the place. And even though the overall trend that you can see here is negative, it's not negative in a bad way. This is helping me understand via regression. So the way that I know that what I'm doing if I were to apply this same methodology to tracking my technical analysis prowess would be by seeing how tight I can get the results of what I'm doing. If my results look like this, I'm not super accurate. Or if my results maybe have these big upsides, let me give you another plot for another strategy really quick to give you another look at something else. Give me one sec. No, not that. Let's do this. So this is a really near-term example. So this is a much less active strategy. But what I want you to pay attention to with this strategy is how it behaves, right? So in this specific strategy, you can see that the majority of the trades that happen really don't result in much of anything, right? The majority of them kind of just float around super small profits, super small negatives. There's a couple, moderate size negatives, but this is designed to attack these kinds of ideas where one or two of these overwhelms every single one of the losing positions and then some. So this is another example of something that has lower volatility that I would have more confidence in terms of my tracking. So the way to answer all of that succinctly for you, Ambience, is I would look at the results, and you can calculate the actual statistical required by doing like a coefficient variance calculation and then turning that into a required number of trades based on a confidence interval. But most of what you'll find in trading is going to be really, really big numbers. So you can do that for context, right? And see like, okay, you need 15,000 occurrences or something crazy like that. But what you can do is track how the strategy evolves over time. And if the strategy positively evolves, meaning we're continuing to see for this strategy, the downside, larger downside to be infrequent and to not be expanding, and then to see this middle zone behaving about the same, and then the up zone maybe increasing in frequency or remaining the same, then you could be pretty confident in that. But this is, again, something that I took a really short-term window on. This is part of a longer-term strategy. So it's highly relative to what you're doing. So if you're doing something that has a lot of occurrences, you can just track the deviation of those occurrences. And as they're tightening up, you can naturally gain more confidence that what you're doing is predictive in some way. If it's something that's less frequent, then it does take a little bit more time to get that same level of confidence. One other note is a really good way to test this is to go back in time and to either manually backtest or to do, written back tests to get a bigger data sample so that you can kind of test ideas quickly. The main thing to keep in mind is like when we're back testing stuff, the real intention behind that is not to like find things that work super well. It's more just to get rid of shitty ideas. And it's because a back test that looks good is kind of like table stakes. You can make any back test look good. So the way to look at it is like if you're back testing something and it doesn't look good, well, then you really know that that's something you just throw out. If you back test something and it looks good, that doesn't actually mean that it's good. It just means that it has potential. And that differentiation, I think, is really, really important as you think about this stuff. So now the last thing that I want to talk a little bit about before I get up out of here is I want to take a look at some of just the recent market flows, because there's been some really, really, really interesting trends to me that I want to share with you guys. So the first thing, is monitoring sector inflows and outflows has been very, very curious. So mostly what we're noticing is a pretty wide spread, but there's a couple big directional shots being taken in some more of the tech space, which again, I generally find that interesting just in terms of like a premium perspective. If we take a look at what's happening in terms of actual ETFs being built out or coming down, TLT is actually starting to be built out slightly. This is interesting because we can see over the longer term, it's actually been running net negative. So I'm keeping an eye on this to see if positioning is actually becoming more bullish, potentially. Too early to tell. ETH A has been absolutely crushing and running. This has been one of the easier trades that I've come across so far this year. And it's because we actually got the flash that something was going on way back here. So what ended up happening is as it's going through this consolidation, literally all I do is set an alert on something like this as it starts to break out above the consolidation. In that case, when I start to see a breakout above the consolidation, I evaluate the quality of the breakout. One of the things that stuck out to me hardcore was the volume on this day, which was 9 July, was 44.5 million. The 20-day average volume was 20 million. The 5-day average volume was 26 million. So there's a really important trend to decipher from that. That is, the longer term trend is lower than the short term trend of five days. So that tells us that in the near term, there's absolutely a build out of volume going on. And then we can break out the quality of that volume, which we can clearly see is generally bullish upside volume. So I'll show you a couple different trade ideas, and then I'll show you what I did here, because I just think it's a good example of using a pretty simple thesis. So let's go back in time and let's go to the 9th. And then we need to fast forward into the day just because to catch the move as it unfolded. Cool. So now, knowing the future, knowing what was going to happen, what kind of trade would you put on? What do you think? This is in the context of knowing the future, which none of us do. But if you did, what would you do? This is one of the really good exercises as you're trying to understand options better at a fundamental level. So what kind of trade? So recess up. Yep, we know that. So then based on that, what kind of trade do you think you would build here? Again, the reason for this exercise is obviously not to see how much money you would make and stuff like that. It's essentially useless from that lens. But this kind of exercise is actually incredibly useful from the lens of trying to get a better understanding of options and what will make good money. Reese says go on a single or ratio call diagonal. Okay, so let's test a couple different ideas. One idea is trading a long at the money call. We'll throw that in here. Another idea is doing some sort of synthetic long. Here. Another idea, buying shares. Here. Another idea, selling puts. So the first thing that we would want to do here is actually compare these on a like scale. So to do that, we need to figure out what the cash requirement is for these different positions. And obviously the stock position is always going to be the most expensive. So if we take a look at the spot price of 2082, and I need to clear all the formatting from here. So 2082. Why is that fucking percent still there? And we're going to grab 100 of these. Yo, why are these percents still here? I recently, not super recently, but I made the switch from Excel to Google Sheets. So I'm still learning Google Sheets. But I don't understand why when I clear the formatting, it still fucking keeps the formatting. I'm actually going to ask ChatGPT. How can I fully clear the formatting back to default of a selected range in Google Sheets when I use clear formatting? It still maintains the number formatting. You literally need a fucking script? Oh, that's so lame. Or you have to like right click and fucking, that's super lame. Okay, so let's take a look at the rest of these. So there's the 21 calls. There's the 21 synthetic long. There's the 19 puts. All I want to do here is show you guys the profitability of these different positions in different contexts. The main thing to note is when I'm playing this, I'm playing a nearer term expectation of a pretty strong price movement. So this is not something that I'm really building to hold for a long time, which is why I didn't go with anything like ratio call diagonals, because those are really generally designed for slightly longer campaigns. So let's just fast forward now really quick. We'll go to the 28th. That's as far as it'll let us go. And then we'll just measure the profitability of these scaled. So the 21 calls, we would have got them for 252. The synthetic long, we're going to pay 2 pennies. And then the 19 puts, we're going to get 146. Okay. So let's check our P&L at this point. On the 21 put, the current P&L would be 545. 585, my bad. The synthetic long is at 790. The 19 put is at 120. So now what I need to do is normalize all these against one another for you. So essentially, all I'm going to do is say how many of these would I need. Now, again, in a regulation T margin account versus portfolio margin, you're going to need different rates. I don't know what the regulation T account would require for the synthetic long position. I can take a look at what the PM account would require. But a big part of that is obviously applying leverage. So let me grab ETH A. And this will be at 28 bucks, so it'll be a little bit more expensive, but it'll still be close enough. So we're going to buy the call, sell the put for synthetic long. And this is asking $883. So this costs $883 per. This one costs $252 per. And then the 19 put. Let's see what the 19 put gets us. Or again, I'll just do a 30 delta so that it's something at least relatively close. In portfolio margin account, this asks for 250. Almost close to that goddamn Loch Ness monster. 250. This is how much they all made for one lot. So now we need to scale these so that we can normalize how many go into this. Oops, wrong one. So all of these, we obviously have to round down. So that's how many we can get. And then this shows you your relative P&L of each in a million different percents because it's still formatting fucking weird. So what do we see? We can clearly see that the leverage provided by getting more calls absolutely will pay you the most. We can see that the synthetic long is in a close second. And then we can see that the short puts are just light years away. They're not even close. So the thing to keep in mind when playing stuff like this, making sure that we're picking the right strategy to help capitalize on what we're expecting to see. What I ended up doing was actually kind of like a ratio synthetic long. So what I did was I essentially bought the version of these calls and then I sold puts against the calls, but not at a 1-to-1. I just did it at a ratio because the cost of the calls didn't matter that much. I really just wanted to offset some of the theta of those long calls. That's all. So I didn't need to recreate the actual synthetic long for the total exposure. I wanted them via the long calls. So super simple trade. Wesley says, appreciate you sharing your time and knowledge. You're a good man. I appreciate that very much. I really hope that these help people. That's why I do the streams that I do on Wednesdays and Fridays. I've done streams for the community for a really long time, ever since I kind of stumbled across them. And yeah, I'm really glad to hear that. I appreciate you saying so. So to wrap us up, a couple last items that I want to show you specifically from what the broader market is showing us. Because there's a handful of things today that looked really, really interesting. And it's been picking up ever so slightly, I think, on top of that. And I'll show you. So if we take a look at MS. That's pretty crazy, isn't it? So this came across really, really early. And this is a wild fucking wild move that you see in here. This is like I don't even know what the standard deviation is. It's got to be like minimum 5. Absolute minimum, because the scale on this can be a little difficult to pick up. What is this here? Yeah, this is only 1 million. This went up to 15. This is 15 times the largest long call volume in the last 14 days. And this is over the last month. So this was a very, very interesting trade to me in terms of total premium that came through. So if we take a look at what actually came through here, and we sort this by premium. Let me get rid of all this stuff. We'll do the last 7 days. We'll get rid of, we want to sort this by premium. Take a look at these. the 120s in August. 130s, 125s, 135s, 115s. But take a look at the expiration. The expiration was getting absolutely smashed today. So this to me is a very, very, very interesting, very, very interesting speculative play that I absolutely like to mirror in different ways. So I have a position on now in here, kind of just following the broader flow. But I thought that one was pretty interesting. Kirk says, would it be better to go synthetically long on SQs rather than synthetically short? Hold on. Synthetically long on SQs, synthetically short on Qs due to risk. Really depends on how you define risk. Because there's total capital at risk, but then there's also volatility. And then Reese says, how's the mentor doing? Haven't heard an update. Yeah, he's doing well. So yeah, thank you for asking. He's now dealing with the bigger issue that he's been dealing with for much longer, which is cancer, but he definitely is post-stroke and he's doing shockingly really well post-stroke. So he was, he's like able to fully talk, move around, take care of himself. So it's absolutely awesome to see all that. So yeah, he's doing pretty well. Thank you. Anything else you guys want to hit quick before I get up out of here? Gave you a couple ideas to think about in terms of what's going on around the tariffs. We took a look at the dissent going on in the Fed. We took a look through some specific earnings releases, noting specific weakness in UPS, whereas the rest of what we looked at did appear to be fairly strong. We spent a little while talking about a couple recent trades, so got through a bunch of stuff. Crazy Trader says, did you see my comment earlier? No, I did not. Sorry. Crazy Trader says, have you been tracking 2-year versus 10-year? Long-term trend is going higher. Don't know if we got off talking about the Fed today. Yeah, definitely. The yield curve has been highly predictive for some time now. And yeah, I fully, and then even if you add the 20-year on top of it, I wonder if I don't know if Thinkorswim has like a yield curve that does all different yields on one. That would be kind of sick. Let me see if, stop this. Let me see if Thinkorswim has anything. Does Thinkorswim have any plots or tickers for yield curve? Because you can do pairs and stuff, but I actually want, yeah, see, it only does like 2 of them. It does like 10-year versus 3-month, and then obviously the 2-year to 10. I'm curious if we could do other combos. That would actually be kind of cool. So you can see the 10 to 2-year here. So it's kind of still at the lower handle of what it's been, but it's not super low. It's still relatively pronounced. And this will be an easier way, I think, for most people to visualize. Yeah. This inversion is still kind of nuts. This is what I was talking about, though, the move in the 20-year. So the 20-year has been moving. I've actually been paying really close attention to the further tail. The near term stuff, eventful but expected. So It's really the long tail expanding on the 20-year that I thought was really interesting. But yeah. Sweet. All right, gang. That's all your boy got. For tomorrow, for the Pro Plus members, we're doing a workshop on building probability cones. So finding ways to help traders forecast expected ranges of things within multiple standard deviations. So looking forward to that. As always, if you need anything, hit your boy up. Be an outlier. See y'all later.